Thanks. Vice Chair Huizenga, Congressman Foster, members of the committee, thanks for the chance for being here today. The capital proposals being reviewed by the committee reflect a new and cogent approach to capital regulation. The agencies focus on risk, assess it asset by asset, and show their work. The result will be a capital regime that better reflects risk with substantial benefits to U.S. economic growth. That said, there are significant ways that the proposal undoubtedly overstates capital needs. First, it presumes perfect correlation in losses among credit, market, and operational risk, and simply adds up the capital for each. But in many cases, those risks are not correlated at all. For example, loan losses are not correlated with AML or consumer protection fines that are now the largest cause of operational risk losses. So the same dollar of capital can serve as a cushion against both. Second, while the agencies helpfully acknowledge double counting between the Fed's stress tests and the Basel rules, they have not presented a comprehensive way to reduce it, particularly with respect to market risk. Finally, on credit, some of the Basel risk weights are clearly overstated. For over a decade, large banks reported the results of their internal credit models, providing a robust data set on what an appropriate risk weight should be. That data shows that for a business-rated investment grade by a bank merits a risk weight of approximately 30%, less than half the 65% it would receive in the Basel proposal. The risks for other loans are similarly overstated. My testimony reviews the proposals in great depth, so I will use my remaining time just to debunk a few canards that have arisen about capital regulation. The first is that banks with more capital fare better in a crisis, and thus any increase in capital requirements is a good thing. Certainly, ex post, in crisis, banks with more capital do better. Of course they do. The trillion-dollar question, though, is whether the costs of carrying that capital at all times exceed the benefits. As an analogy, wearing a helmet would be helpful if you fell down or were in a car crash, but we don't wear helmets all day and night because that comes with costs. There is no dispute among regulators or serious academics that higher bank capital requirements reduce the availability and increase the costs of bank lending and intermediation. That's what makes capital regulation hard. A related canard is that banks should be indifferent to capital levels because higher capital improves their credit ratings and reduces their cost of issuing debt. Of course, if this were true, bank investors, analysts, and customers wouldn't much care about higher capital requirements, but of course we know that they care quite a lot. And bank CFOs allocate capital to each business line and adjust the amount of capital when regulatory capital requirements change. That's because capital requirements are a very important cost of doing business in the real world. A third canard is that the failure of Silicon Valley Bank somehow argues for higher capital for all banks. Notably, the banking agencies have never argued this point, even in the 2023 capital proposal. That's because they understand that SVB failed for interest rate risk and depositor concentration. The pending capital proposals are about credit, market, operational, and derivative counterparty risk. The agencies have responded appropriately to SVB by refocusing examination on material risk, updating their liquidity rules, proposing a gradual phase-out of the AOCI filter, and reforming the FDIC's broken resolution and recovery process. A final canard is that banks need more capital because there are rising geopolitical and cyber risks. The Federal Reserve actually runs a stress test which recognizes that banks lose money when unemployment rises, GDP falls, and housing prices fall. It does not matter why those things happen. A war, a virus, technological change, the drivers of loss are the same. And so the Fed properly focuses on the loss drivers and wisely does not try to predict geopolitical or pandemic events and adjust capital accordingly. Furthermore, it is worth noting that capital does not actually protect a bank against a cyber attack or many similar risks, as important as those risks are. It reminds me of a Far Side cartoon with a picture of a horse and a chart entitled Equine Medicine. Two columns show diagnosis and treatment. The diagnoses vary: broken leg, runny nose, fever, ornery, but the treatment was always the same: shoot. For some, the treatment of any bank problem is similarly the same: more capital, ad infinitum. Fortunately, the banking agencies have decided to say nay to that approach and instead use thoughtful analysis to build a capital regime from the ground up. That's it for me. Thanks for your time.